Good morning. Welcome to Trading Hour. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. I am Reema Tendulkar. With me is Vivek Iyer, and things are picking up for the market. It was a quiet, flattish start, but now in the last 1 hour, there is momentum, and markets once again are advancing. The Nifty Sensex up close to about 0.5%. The Nifty is now closer to 24,250. The Sensex is at 79,800 after soaring close to about 400 points. Banks once again providing the leadership. The Nifty Bank is up more than 1%, and mid-cap, small caps outperforming. Things are looking up and looking good.
Good morning, Reema. Absolutely right. After the kind of handover it received, as well as how Asian markets opened, actually worried that we would see quite a weak start. GIFT Nifty was actually indicating a very subdued start. But despite that, we've actually seen a significant up move as far as markets are concerned. What's taking the markets higher? Well, it's the same story today as well. Banks as well as NBFCs. RBI's final LCR norms are much less restrictive compared to what they were earlier, and the entire banking pack today has built onto the gains, especially names like HDFC Bank and Kotak Mahindra Bank. Some of the PSU banks too doing very well in the session. Bank of Baroda up 3%. The other, lot of banks, also a lot of news flow as well. So RBL Bank, a very large trade in that particular name. British International Investment, earlier known as CDC, has most likely exited the complete stake in the company, a little over 3.8% stake, and the stock too has seen quite a sharp recovery from the day's lowest point. Remember, RBL Bank has recovered quite significantly from the recent lows. IndusInd Bank, on the other hand, reports are indicating that the company has gone ahead and appointed EY to conduct another audit this time around to probe a 600 crore discrepancy as far as the MFI portfolio is concerned. IndusInd Bank at one point of time was down almost 7%, has spared some of those losses, still trading with cuts of a little over 3.5%. A couple of stocks, especially from the solar energy ecosystem, both Wari as well as Premier. Both of these stocks, Wari up over 7%. Remember, they also report numbers a little later today. Premier Energy is up almost 6%. USA has gone ahead and imposed very steep duties on the peers from Southeast Asia. And some of the tariffs are all at almost 3,500%. So very high tariffs on some of the select countries and companies. Indian companies seen benefiting. And lastly, very few laggards today, but two-wheeler stocks, both Bajaj and Hero, on the back of downgrades from Jefferies, today seeing a bit of selling pressure, Reema.
Indeed. Let's invite our market guest, Jitendra Arora from ICICI Prudential Life, to join us now to discuss the market fundamentals and his top sectoral bets. Jitendra, I wanted to start off by asking you about banks. The Nifty Bank was the first sectoral index to get back to its record high. It had fallen the least also in the global turmoil, but the way the banks have moved up, it's been a nearly 8,000 point rally over the last couple of days in more than a month on the Nifty Banking Index. Where from here are you overweight banks? Would you buy banks at current levels? And in the financial space, let me rephrase that, what would be your top picks?
Good morning, Reema. Yeah, so I've appeared on the show earlier also, and I think at that point also we highlighted that from a domestic perspective, we continue to like banks. So banks have been one of our favorite picks for last 6 to 12 months. And we continue to hold the same view even as of now. Because if you look at the medium term to long term earnings construct and growth construct and put the valuations on top, we believe that the risk reward for Indian private sector banks is still one of the better ones in the current market. So yes, the banking sector will be one of our overweight calls in the current market.
What about wealth management within the financial space? We've just seen a very large deal brewing now. UBS will be acquiring a near 5% stake in 360, WAM. And wealth management has emerged as one of the fastest growing sector in the financial industry. Do you like wealth management? Is it a part of your portfolio?
So we do not own wealth management companies because, again, by calling it a sector, it's a specialized wealth management companies are still very small part of the overall market. And you do get to play some part of wealth management by owning private sector banks because they also participate in their own way in this industry. But given the rising wealth accumulation by the Indians, obviously it's a very, very interesting segment of the market. However, one must remember that as you become wealthy, the capital can find other shores as well. So then, in some ways, it is also part of a global industry at large. So you do not get to retain everything on domestic shores. So to that extent, there can be plays which will compete with you from the international markets rather than only in the domestic market.
Jitendra, how do you then play the capital markets team? Do you feel that an exposure maybe to some of the exchange stocks would be a better play, would be a better way to play this particular theme?
There are various plays available on the capital markets. You can play it through the long-term savings players like insurance. You can also play them through mutual funds, and you can also play them through various exchange and transaction-related plays like RTAs as well as the exchanges. So those are some of the plays available, and some of them have shown remarkable long-term growth. Something like a mutual fund space has shown a remarkable growth over last 20 years in terms of AUM as well as earnings. And I think they are one of the ways to play the entire theme per se. What one has to be cognizant about is essentially the point in cycle where you are entering and exiting, and what kind of multiples are you paying from a short to medium term perspective versus a long term perspective.
Completely take that point up. How are you now looking at the export space? A lot of worries about tariffs, but most of the stocks have recovered quite significantly from the recent lows. So how do you look at the pharma pack in particular? Still tariffs haven't been announced there, but it continues to remain as an overhang.
I agree. But having said that, I still believe that pharma will remain a relatively insulated sector from a tariff perspective. That's what my belief is. Having said that, you will still want to wait to see what's the news coming on that front, because the segment where Indian players are competing, which is essentially the generics, I think we have a fair bit of cost and pricing advantage there. However, our linkages to China in terms of KSMs and APIs is fairly strong. So to that extent, how does that affect the overall sector remains to be seen. But I believe that pharma will remain insulated from a tariff perspective overall, given its critical nature to the US consumer as well as our own cost competitiveness there.
So your overweight financials broadly, what else? What else do you like at these levels? Tell us what you're holding in your portfolio, and also incrementally when you have to go and buy, because not all the themes that you own in your portfolio will offer the risk reward to give you an entry point. So what would you buy at these levels?
Carefully evaluate some of the retail plays which have been depressed in the current market. We are overweight retail significantly in our portfolio because, again, it's more a domestic consumption growth story which we are trying to play through Indian retail players per se. Within that, you will find that there are names which are currently depressed because of the recent performance. But if you believe in the long-term performance of some of those companies, you will still find them investable even at current points in time. And then you will always have relative plays available within the space wherein you may want to sell something and buy something, even though it may appear pricier. In terms of other segments, I think you will find a lot of cyclical names which are undergoing correction, and I think another 5 to 10% correction in some of these names will make them very, very interesting opportunities from a 2 to 3 year horizon, given that some of them are undergoing a cyclical depression in their margins as well as are facing slowdown in terms of their revenue growth. But if you look at the long-term prospects of some of these companies and the multiples where they have reached, I think you will find good, interesting entry points in some of these names.
Sorry, in cyclicals, you mean auto? Which sector are you looking at?
Something like, for instance, building materials.
Building materials.
So
any other?
Pointing out. In autos, I still think there is some more pain perhaps we are likely to undergo. Similarly, IT also, I believe we are likely to see some more pain. But I think another 5 to 10% lower from current prices, IT would have priced in a significant amount of pain, and we can look to buy into that also with a 2 to 3 year horizon.
Right. Jitendra, you mentioned autos and IT where are two sectors where you expect to see some more pain. Conversely, which are clear sectors that you will be avoiding at the current point of time? Any red flags from any sectors where you feel significant downside still remains?
So nothing per se in terms of a very significant downside at the sector level, because every sector honestly will have players which have not done well even in the current move, and some players which have overextended themselves. So obviously it has to be a bottom-up market per se. So you'll have to evaluate every company from a bottom-up perspective, irrespective of how the sector is doing, because there'll be banks which have not done well in the current banking cycle also from a long-term perspective. But that does not make them a buy per se.
Now, within some of the domestic names you mentioned, consumer durables, how are you looking at them? Names like Havells, Voltas, the upcoming summer season, do you like them at these current levels?
We'll avoid discussing names, but
Right.
the consumer durables, we do have some plays available where we believe we had bought them in the recent correction, and the valuations had also corrected. So we have exposure over there.
Okay. And one final word, you spoke about retail, where you are evaluating opportunity. Without getting into stocks, but are we broad, when you talk about retail, are we looking at the DMarts, trends of the world? Or
So
are you also looking at footwear, apparel, etc.? Some of the other
So
names.
apparel, for instance, may be interesting at this point in time because again the valuations have corrected, and also we are seeing earnings slow down. But with the government move on taxation, we expect some of these names may see some kind of growth coming back to them. So yes, that's an interesting space.
Thank you so much, Jitendra, for joining us and giving us a view across a whole host of sectors. Get you soon on the channel once again. Well, we now slip into a short break. We'll get you key expectations from HCL Tech earnings on the other side.
Welcome back. After yesterday's 2.5% up move in the tech sector, today it's a little subdued, so down about 0.5%, maybe taking cues from the Nasdaq performance overnight. Now, all eyes will be on HCL Tech. HCL Tech will be the fourth IT company to report their earnings, fourth large cap IT companies. We already had numbers from Wipro, TCS, Infosys, and broadly it's been a disappointing set of numbers. Now, from HCL Tech, the key to watch will be their guidance for FY26. Remember, Infy gave a guidance of 0 to 3%. For HCL Tech, the expectations are maybe closer to 2 to 4%, maybe 3 to 5%, some of the optimistic in an optimistic scenario. But they could also choose to be a little conservative and give a wider range, maybe a 2 to 5% or a 1 to 4% kind of a revenue guidance. Margin guidance likely to remain unchanged at 18 to 19%. But that's going to be the key to track. Now, onto the Q4 numbers. Like we've seen with the rest of the large cap IT names, expect a sequential revenue decline. All the companies have reported in the large cap space a revenue decline on a quarter-on-quarter basis. For HCL Tech, dollar revenue seen down 0.9%, constant currency revenue growth seen down 0.6%. For HCL Tech, the key reason for the revenue drop, one, is weak seasonality. Secondly, there was a large retail project which came to an end in Q3. So when you compare it quarter on quarter, there will be, that revenue will be absent in Q4. So that will hurt. And also the company had indicated that some of these new discretionary projects are a little slow to start. So that could be another factor. Margins for HCL Tech at seen at 18.1%, again lower on a sequential basis. And here the reason is, one, negative operating leverage, your top line has declined. Two, wage hikes come in. And three, visa costs. So therefore, margins are seen down 140 basis points. Let's see, Infy also missed. Infy was a big miss compared to expectations. So now all eyes on HCL Tech. But again, it won't matter because March is done. What they have to say about FY26 in terms of new projects, and are they being paused? Are they being cancelled? Are they hopeful of things stabilizing now? I think that's going to be key.
Very similar to what Tata Elxsi did, right? Commentary was a lot better than maybe what the street anticipated. It was a sharp mover today. Thank you so much, Rima, for taking us through what are the key expectations as far as HCL Tech is concerned. We'll now take a short break. Abhishek Kapoor from Puravankara joins us on the other side to discuss their FY26 outlook as well as the operational update they gave the exchanges. Welcome back to Trading Hour. As promised, we're now shifting focus to the real estate space. Puravankara, the company, remember, yesterday reported its Q4 FY25 business update and saw a decline in both pre-sales as well as collections on a year-on-year basis. They believe this is due to approval delays that have led to temporary deferral of launches and reveal a strong launch pipeline for FY26. To discuss more on this, we have Abhishek Kapoor, Group CEO at Puravankara. Thank you so much, Abhishek, for joining us. Even last time we had discussed the fact that there appears to be quite a few delays coming in as far as regulatory approvals are concerned, especially in Karnataka. What is the current on-ground status as far as the approvals are concerned, and how many projects of yours have been pushed forward due to these particular regulatory delays?
Vivek, thank you for having me on the show. So just one correction on your previous statement. We have grown the collections by about 9% year on year. Having said that, I think from the perspective of new launches, we are looking at about 13 million square foot of new launches in the coming year. About 6 projects got deferred in terms of launches, which could have come in the last year itself because of regulatory approvals only in Karnataka itself. Having said that, I think we are very, very positive. In the 13 million square foot, we are expecting 6+ million square foot to be launched in the first 2 quarters itself. And other than that, what's good for us is also the fact that we have deployed about 1,300 crores in the last year, which is generating a GDV of almost 13,000 crores, where we have locked in lands. Of course, the idea is that you create a robust pipeline of lands to be able to launch in the upcoming financial years.
But Abhishek, for this 13 million square feet of launches that you're planning in FY26, is there a regulatory risk that the approvals don't come through and you fall short?
Look, that risk is always there. But having said that, I think what we work towards is that we move all of the projects. What typically may happen or can happen is that some change happens at a later date. And if that policy change affects the approval, then it gets delayed. But having said that, see, these lands are all paid for. The plans have already been submitted. Of this 6 million square foot is in advanced stages, which we are quite certain that should be taken to market before in the first half of the year itself, and the balance will spill over. So that risk, to be honest, is always there, but that only defers the launches. It does not affect in terms of the value that it brings to the table as far as the company is concerned.
Okay, Abhishek, we want to clarify on a couple of numbers from you. We understand that at the start of FY25, the launch pipeline was close to 17 million square feet, right? And we understand that at the end of FY25, you've managed to launch close to 13 million, remainder being impacted by regulatory delays. What was out of the total launch pipeline? How much square feet actually went on sale? And what is it that you expect to recoup in terms of deferred sales by Q1 and Q2 of FY26?
So, Vivek, to just, you're right, I'll just clarify that. About only a short of 4 million square foot is what we took to the market last year. In fact, I would say large amount of projects got deferred largely on account of regulatory approvals, of which what was deferred, which would be about 8 million square foot, of which what I'm suggesting now is about 6 million square foot will go to the market in the first half of the year. And then the rest will get deferred, and of course, and not deferred as in they will come in the second half of the year. And in addition to that, some of the new projects which were acquired will also be taken to the market in this year. So overall speaking, I think almost 8 million got deferred, of which 6 million will come to the market within the first half of the year.
Okay, got that. So last year you planned 13, but you managed to do only 4 million square feet. And again, this year in FY26, you are planning about a 13 million square feet, and a lot of it will be a carry forward from the previous year. So your collections growth, while it is 9% in FY25, it seems slightly lower. What are you anticipating on the collection side for FY26? Will there be a pickup?
Right. Rima, definitely with the new launches, there will be a pickup. And that will add, that will show collection growth, especially in the second half of the year. Because first half of the year, when we do these launches, the collection actually start to hit the business in the second half of the year. Other than that, I'd also like to share that we are getting OC for about 3.9 million square foot in the first half of the year, which also will see possessions coming through within the first 9 months of this financial year, and therefore that will also reflect in the revenue recognition and the collections of the business.
Abhishek, FY26 on a base of a little over 3,900 crores of collections, what is it that we can pencil in for FY26? And pre-sales, given how revenue recognition is done now, on a base of a little over 5,000 crores, what is it that we can expect?
Vivek, we don't give guidance. What we share is the numbers.
A directional number, sure.
Yes. So for example, as I mentioned, 3.9 million square foot of OC will give us about 3,200 crores of recognizable GDV in this financial year. That's a number which is pretty much given, so I can. It's not a forecast; it's a given number. As far as the new launches, as I mentioned, 13 million square foot is what we are targeting. We expect to open, in terms of open to sale, at least 9 million square foot, and that should provide us with a total at an average realization of say about 10,000 rupees a square foot. Will realize about 9,000 crores of GDV of launches should go to the market. And basis past performance, one can make estimates of what kind of numbers we will show. But definitely the company's focus is on ensuring that we have good growth in the pre-sales numbers from the 5,000 number for the last financial year.
This 9,000 crore of gross development value GDV is for the first half of the year that you estimate, right?
Total for that we'll open for sale this year. While 13 million you will get the plan sanction, what happens is that you don't open the entire inventory for sale, you open parts. So we will open about 9 million square foot, and that should result into about 9,000 crores worth of GDV being taken to market. Other than that, we will continue to do sustenance sales where we have projects which are ongoing. And we have performed very well. In fact, last year, we have grown our sustenance sales by 22%. If you break this down a little granularly, the brand has really performed well, and the group has performed well on the sustenance sales. The impact largely has been on account of new launches which got deferred.
Abhishek, give us a view, number one, or give us what is the on-ground trend. Number one, when it comes to demand, is there enough demand when it comes to new launches? Price per square feet or realization, how is it shaping up? Can we expect to see an improvement year on year? And what is the new launch pipeline, especially given the impending entry into the Maharashtra market?
So to answer on ground, I think the momentum continues in terms of sales in the markets that we are present in the West and in the South, where we have inventory for sale. The good news has been commercial absorption has been quite high, which shows that future demand is also there. Fortunately, this is non-perishable demand, and it continues to hit the market as and when it does. Now, as far as our launches are concerned, the 13 million square foot that we spoke about, it's broken into Mumbai or West and South. If you look at it, about 3 million square foot will come in Mumbai, and about 10 million square foot of this will be in the other markets, rest of the country. If you look at the overall performance that we are expecting out of this, I think West will increase in terms of the contribution, and therefore the average realization, especially because of Mumbai projects, will get pulled up on a per square foot basis. So while last year we were at about 9,000 to 10,000 rupees a square foot, that will definitely go up because of the launches in the West.
Just a quick question, Abhishek. What's the reason behind all these approvals coming in on the regulatory front? What is the concern? And on the whole, do we have numbers for Karnataka? How many projects have been delayed? And why will FY26 be any different? I mean, have you heard from them that this time they're going to go faster on the approval front?
Look, I think I'll tell you the sequence of events, and this is an industry issue. It's not just a Puravankara issue. In the sequence of events was the elections, and then post-elections there were a lot of changes in the policy. Some of the examples were like e-Khata, which took some time settling. Some more further changes were brought in the regulatory side, and what happened is that the government also has a capacity to process so many files, and that is a certain capacity. So, for example, if a department has capacity to process 100 files, due to the delays and changes, we had a bunched up files of say 150 files were there, and therefore that got clogged into the system. So now that the files have started clearing more frequently, and the system's kind of stabilized and the changes have kind of played out, we are expecting that next 2-3 quarters you will see that most of the clearances should come through. That's where the confidence is coming from.
Thank you, Abhishek, for joining in. We need to slip into a very short break. On the other side, 360 ONE and UBS have inked a wealth management deal. We'll get chatting on this with both UBS and 360 ONE's Karan Bhagat to talk more about this collaboration and what it means.
Welcome back. The big deal, of course, which was announced this morning was in the wealth management space. 360 ONE has acquired UBS India Wealth Business. It's entered into a collaboration with UBS AG, and UBS is also investing into 360 ONE. It's taking just under a 5% stake in 360 ONE. Let's talk about this big deal. We, of course, did an industry discussion at 9:30 this morning with a couple of players from the space. Now let's talk very specifically about this deal. Karan Bhagat is with us, founder and managing director and CEO at 360 ONE. And Jin Yi Young is co-head of UBS Global Wealth Management, of course, Asia Pacific country at UBS Singapore. Thank you very much, Karan and Jin, for joining us here. And congratulations from all of us here at CNBC-TV18 on this big deal in the wealth management space. It's booming by all accounts. And Karan, you've been an integral part of it, widely acknowledged as having built this sort of institution with your team. So first of all, congratulations. Tell us a little bit about this deal, Karan, if you will. What does UBS India Wealth bring to 360 ONE?
Thanks a lot. Yeah. So thanks a lot. I think thanks for all the kind words, and it's lovely to be sitting here with JY. I think we've been having a lovely partnership discussion for the last 1 odd year, and has led to this unique collaboration. I think most importantly, what it gets to us is widening the platform for the client, and that's really what I think comes core to the culture of both UBS and 360 ONE, is to serve the clients in the best possible way. And I think given UBS's entire global reach across the globe, it allows us to be able to ensure that as our clients become globally more mobile and also diversify their asset classes, I think we have the ability to offer them the best platform which is out there. And secondly, most importantly, I think, UBS from a business perspective has kind of built very, very strong alignment on the wealth management space in terms of culture on how to manage the client's portfolio in a diversified, risk-adjusted asset allocation approach. I think we have a lot to learn from them on what's happened globally, and that's something which both our employees as well as us will be able to take to our clients better. And thirdly, I think as a deep sign of collaboration, I think both UBS's investment into the equity warrants in the business, as well as our partnership in terms of, or our collaboration in terms of looking at the Credit Suisse and UBS business folding into our business, should add a lot of value to both our clients.
Karan, just the basics. You're buying the wealth management business of UBS, the UBS India Wealth Management business, but you're also buying the broking and other sort of businesses as well. That is also part of this broader deal.
No, it's the brokerage business, which is a subset of the wealth management business, not the institutional equities and the investment banking business. So the wealth management business basically includes a broking license, includes the portfolio management business, the distribution business, as well as the loan business associated with the wealth management business.
Okay. My question, because I mean, you recently acquired BNK, so that kind of sort of piqued my interest in terms of whether if you're going in for, but of course it's not the institutional business, it's the broking business of the wealth, the broking side of the wealth business, which comes with it, I'm assuming, I mean, which kind of brokes for the wealth business in that sense.
That's right.
And Jin, if I can come to you, congratulations. you're investing 4.95% in 361. What's the logic you see here, and what motivated you? Selling the wealth business to 361 and then picking up just under 5% stake in the business.
So if I may just, just share with you the logic behind this transaction is that, first of all, we want to bring this word global to the next level. So this transaction basically combines the global and regional reach and capabilities of UBS, combining it with the reach and the capabilities of the local 361 India franchise. And this really, we believe that we are best placed to actually serve our global Indian clients, both domestically and also globally. Now, the transaction, it is quite complex. It's actually comprised of 3 pillars. The first pillar is really the collaboration, the strategic collaboration, which is exclusive between agreement between UBS and 361 that anything to do with domestic business is actually handled or managed in the good hands of 361, whereas anything global will be handled and managed by UBS. So in that way, we are able to actually collaborate really well. We entered into really good collaboration mode, and we are setting up a joint committee to actually make sure that we identify, explore, and also monitor and review the future potentials that we have. So that's really the focus of the whole collaboration is really on the collaboration, the strategic collaboration agreement. Now, the second part of the transaction is really the business transfer. So that comprised of us transferring our UBS wealth management in India to 361 to really allow our clients to benefit from the expanded wealth management capabilities onshore, right? And at the same time, for the clients who actually booked out of Singapore, 361, to actually be able to benefit and manage and serve by UBS. Of course, these are all subject to regulatory approvals.
Sure.
And the third pillar really is the warrant, right? Well, we all know that the wealth management, scene in India is really, really, growing at an exponential rate. And simply put, right, we really want to have a piece of the pie too. As you can see, these 3 components add together. We are really intertwining together our capabilities and making sure that we are able to serve our clients, global Indian client wealth management, in the most holistic way.
So at the margin, if one is analyzing the wealth business, right, incrementally, one can make out the case that UBS is getting out of the country from its wealth business, but it's really not. You're selling to 361. So how should we read it? I mean, is it part of a global kind of realignment of portfolios across markets, Jin, at UBS?
No, so what I just described today, just now, is really from a wealth management perspective. Really, is we are 2 companies. Put it this way, we are 2 organizations coming together to serve the global Indians, including domestic Indian clients, and also global
I get
Indian
that.
clients in the most holistic way, and capitalizing what we are do best, right?
Yeah.
And that's the reason why we are entering. We are actually taking up the warrants, a stake, is really because we want to make sure that we have, a piece of the pie, going forward as well. So it's definitely not like we are selling off. We are actually reinvesting into 361 to ensure that we actually have the holistic view. And of course, we are expanding our
for this 4.95% stake,
into
Jin,
asset management.
Yeah. For this 4.95% stake, what are you paying in terms of valuation? So 361 is paying about 1.2% of the AUM for as far as when they're buying the UBS India wealth business. What are you paying for this 5%?
So I think that is, we will not divulge details of the transaction, but basically, we look at the transaction in a holistic way. And, in terms of valuation, we both agree that that is the best valuation for both businesses, and that's how we invest into the business. Karan,
you want to tell us, talk a little bit about the valuation in terms of the incoming transaction into 361?
No, I can top it. Obviously, yeah. So we obviously Obviously, from a valuation perspective, we're a listed entity, and we've essentially taken the pricing of the last last 5 days of the volume weighted average price for 361 Wealth. In terms of the UBS business itself, as JY pointed out, it's a good commercial assessment of the value of the business, given the current assets under management, and most importantly, once it gets integrated into our platform, what it can represent over the next 3 to 5 years. Obviously, the business has been built over the last 5 to 7 years. It has a great team, great set of relationship managers, and a very, very unique client base of its own. And I think together with our synergies as well as the global synergies, I think both represent a very, very good collaboration, which can lead to a significantly enhanced valuation.
So this, so the 26,000 crores in assets, I mean that kind of sort of it adds on to your asset base, Karan?
Absolutely, it adds on to our asset base. Yes.
And in terms of margins that you make and that 26,000 crores makes, I mean, could you give us some sense? How does it compare?
So honestly, I think the UBS India Wealth business being kind of private and segmented out, the numbers are not disclosed publicly. But having said that, I think it's fair to say that as a wealth management business, it's more or less representative of a mixed margin between 30 to 60, 30 to 70 basis points. I think typically businesses which are fully kind of pregnant and have the ability to use the entire platform today are anywhere from 50 to 70 basis points in terms of retentions. And other businesses which are in the process of being scaled up and have kind of reached a certain scale, both from an AUM and a number of bankers perspective, typically are at the 30-35 basis points. So the entire business is in that zip code of 30-35 basis points and moving up to that 55-60 basis points. And I think within our platform, it would kind of fold in back into the similar cost to income ratios, which we've been able to build out for the larger business over the last 10 odd years.
Do you expect any sort of client drop-offs, etc.? At all? Or you think you'd be able to retain all these relationships?
Yeah, it's too early to say, but I don't really see. I think it's as JY was talking about it. I think from our side, obviously, we worked really hard to get the synergies right. The combined platform is even a stronger proposition than both the individual platforms were already for the client. Secondly, I think from a culture perspective, as I said earlier, both businesses have traditionally focused very narrowly and very successfully at wealth management, asset management, as well as equities and banking. So I think both from a culture perspective as well as a focus perspective, very close to each other, both in terms of style of doing business also. And then, kind of complement it with the same set of people. Don't see a real reason why clients won't stay on. And honestly, I think, being in this business for the last 2 decades, both me and JY honestly feel that for the clients, the most important thing is continuity, as well as the most important thing is a stable and a strong platform. And really, I think this collaboration in more ways than one is about getting these things together. And I think if we can get these things together, there's no reason to believe we will end up losing clients.
If I may add on this point as well, is that we are very excited about the future of this collaboration. And that was the reason why I mentioned the 3 pillars. The first pillar being the collaboration agreement that is actually the most important, right? Just imagine our global reach of, just talk about NRI clients that is globally within our UBS Wealth Management. They all would like to be served onshore. And we will be able to refer such businesses to 361. And we have a collaboration to actually see how we can make that happen. And likewise, for all resident Indians in 361, we'll be able to access the global facilities and capabilities of UBS as well. That is the powerful part, the most powerful part of our collaboration. And we believe with this, we're able to take the business to the next level jointly.
Absolutely.
Jin, hi, this is Rima here. So if you want to take this collaboration to the next level, would you at some point look at increasing your stake further from the current 4.95%?
Yes, good question. We get that quite a bit, actually. So, like I said, we actually set up a committee, a joint committee that will be, led by both sides of the leadership. We will explore. This is just a really first initial step that we're taking to this collaboration. We intend to take this to the next level, and of course, we are exploring all avenues to do that, and that includes, other options going forward as well. So it all depends on our synergies that we come up with going forward. But definitely, we are keeping that open for now.
What are the other avenues that the committee will be jointly exploring?
Yes, for example, as I mentioned, this is really focusing on wealth management business as well, but not forgetting in UBS, we actually have asset management as well, investment banking as well. And we all know that a lot of corporates in India really want to take their business not just in India but also globally as well. There we can come in to really help. UBS can really help our clients, from an investment banking perspective to bring them to the world as well. So, and that's really from an investment banking perspective. And of course, on asset management, right? We really want to think about, asset management solutions that our global clients will need. Perhaps we can also see how we can collaborate with 361 to come up with solutions that is able to help them assess the Indian market as well. And as vice versa, Indian clients in India would like to have global reach as well. Definitely UBS can help in terms of producing solutions from there.
Right. Karan, this is Vivek joining in as well. Karan, what has been the kind of response, what has been the kind of interest that you've seen from your own clients as far as investing into markets outside India is concerned? So far, there have been quite a lot of regulatory restrictions there, right? So does this open up new avenues, and what has been the response you've received so far?
So I think there's a lot of interest, but obviously all the new avenues remain restricted with what is available regulatorily. I think honestly there are three real options from an investment perspective. First is obviously the automatic rupee mutual fund feeders, where the limits has been capped now for the last 2.5-3 years. At the LRS limits of $250,000 per financial year per individual. That's been quite, kind of utilized quite productively by most of our clients for the last, I would say, 4 to 5 years. In the first 3 to 4 years, most of this money really went to buying a house or for education. But over the last 3-4 years, clients have used it very effectively to build out financial portfolios outside. And recently, I think GIFT City obviously seen a little bit of more relaxation in terms of being able to invest outside. And we've seen roundabout, maybe not only through us, but through all GIFT City providers put together, around about $150-200 million, which has kind of gone out for financial investments. So while the current quantum of amounts remain relatively small on the LRS and the GIFT City side, I think from a regulatory landscape perspective, it's quite clear. I think the regulator has done a phenomenal job in being able to kind of think through some of these aspects very carefully. And I think as time goes by, I think our own ability to kind of offer this to resident Indians within the regulatory ambit would be higher and higher.
Got that. Karan, by the way, to that question of whether UBS will buy more, will we see, what's your sense? Will we see substantially larger holding, year, 2 years, 3 years down the line?
Honestly, it's a really tough question to answer. As I said earlier, I think, Shan, I think for me, honestly, like JY put out the three pillars. For me also, it's
But what is your sense? You think it's possible?
First,
it would make sense?
It's all in the execution, right? I think we've got the platform right. We need to enhance the platform for our clients. We need to be two firms which are aligned on culture. And third, obviously the rest of it, which is the business case, needs to kind of play out. But I think all these three things need to play out eventually to figure out whether that number is more or not. All I can say is, given the fact that both the firms have been sharply in this business, and we spent the last year, I think that's a good starting point. I think all three things have come out well. The collaboration agreements come out really well. I think our own assessment of each other's strengths has come out well. The client case and the client case for enhancing the platform is solid, and the 4.95% is a great start. So I think that's the way I would look at it. And then we have to see how these things play out. I think beyond a point, there's really no large merit in terms of taking a guess there. But I think these three things coming together is really what is exciting me.
But there is no written roadmap or internal agreement, right? I mean, you're down. There's no like some call option kind of.
No, there is no. There is no written roadmap. No, nothing.
It is open, and both of you will sit down and decide
As JY said, it's
progress.
absolutely open.
Based on execution.
Yes,
Thank you.
yes,
thanks very much, Karan
yes.
and Jin Yi Young, for joining us. Good conversation. We wish you all the best of luck as you guys sort of work together in this new partnership, in this new avatar, so to speak. I think that's the news from the wealth management sort of industry. Stocks, I think, up about 1.25%, but it's done well over the over the last couple of days or so. Market's looking up, guys. 90 points, 24,200 plus.
Indeed. So what we'll do is get into a break. On the other side, we'll come back and discuss market technicals. We'll get you a few trading ideas with Mitesh. Welcome back. The Nifty is at 24,200, slipped a tad bit from the high of 24,250, but trying to climb back again. Tata Consumer, Asian Paints are some of the names where you've seen a bit of a drop-off in the last 15 minutes. Mitesh Thakkar is now with us for a quick technical check on the market. Mitesh, what's the approach to trade now, midday, and what would the stock calls be?
I think the approach and the bias is possible. Very clearly, I think this is a market which is looking good, except for the fact that, as I've been highlighting since yesterday afternoon, we are quite slightly overwatched. Therefore, there could be an intraday dip maybe today, tomorrow. But the overall bias is definitely on the upside. I've talked about targets of 24,500, 550, and in a good case scenario, 24,758. So I think that's where we are looking at. In the short term, I have a buy on IDFC First Bank with a stop at about 66 for targets of around 51. And the second stock, which I like, that's one slab, which I would recommend buying with the stop at 639 for targets of 670.
Thank you so much, Mitesh, for joining us, giving us your view on the markets and individual stock calls, both IDFC First Bank and Lotus Labs on your buying list. Well, time now for a short break. We'll get you more on the markets on the other side. Welcome back to Trading Hour. Well, have a look at the Nifty or the NSE PSU Banking Index, clearly doing very well in the session. Central Bank of India, Canara Bank, Bank of Baroda, IOB, the top four constituents today as far as the NSE PSU Banking Index is concerned. Well, one of the top movers in yesterday's trading session was actually Tata Elxsi, almost 11% up move at one point of time. Today, the stock, after a brief dip, has actually managed to build on to the gains that it saw yesterday. The stock now trading with gains of over 2.5%. And other stocks from the pharma pack, we just highlighted Lotus Labs, but Lupin, that particular stock is doing very well. Again, almost a 2.5% uptick on this particular name. A couple of brokerage notes indicating that the company may be in line for a significant drug approval. And on the back of that, Lupin has recovered quite a lot of the losses that stock made, especially after losing the patent litigation as far as Mira background was concerned. But with that, it's a wrap on this edition of Trading Hour. Stay tuned. Halftime Report is up next.